Welcome to Wealth Coffee Chats, folks, for your daily live updates. Get the most out of today's episode by participating in the chat. Make sure you ask some questions, be part of the conversation, have a bit of fun, grab a coffee or a tea, take some notes, and get ready to start your day, folks. Quick few housekeeping rules, though. No spamming, no advertising or self-promotion in the chat. That's not on. Be kind and respectful to everyone when participating. And most of all, have a good time. Real estate investing can be your biggest asset. It also can be your most expensive asset when it comes to getting it right or getting it wrong, folks. It can be time-consuming, stressful, and that's why here at Positive, we have what's called a 6-star team, a full-service team that provides integrated wealth and property investing solutions and services simply designed to help you progress towards your goal of passive income through your property portfolio, folks. Make sure you check out our other podcasts on the Positive Mentor Network. Not only is there Wealth Coffee Chats, there's the Urban Property Investor. Drops every Wednesday with straight talking investing strategies and lessons with Sam Saggers. Property Investor Tales. This is where our clients, you guys, share real life stories from property investing, hosted by some of our advisors and strategists. And that's done every fortnight, dropping every Monday. Wealth, Wine and Wisdom, folks, that debriefs the week that was in the world of finance and property, hosted by yours truly, Jason Witten and Andy Fenton on Fridays. Hey, good morning, folks.
Good morning, everybody. Welcome to another Wealth Coffee Chat.
Hope you're well, folks, wherever you are.
There it is, team. Morning. Morning, wherever you're tuning in from today.
Early bird gets the worm, they say. Here at Positive, we offer a 6-star team. It's a team that help you at every stage of your wealth creation journey.
General advice disclaimer. The information provided and made available through this podcast does not constitute financial advice. The information is of a general nature only and does not take into account your individual objectives, a financial situation, or needs. It should not be used, relied upon, or treated as a substitute for specific professional advice. We recommend that you obtain your own independent professional advice before making any decision in relation to your particular requirements or circumstances. Positive Tax Solutions and its representatives do not warrant the accuracy, completeness, or currency of the information provided on and made available through this podcast.
Good morning. It's Tuesday morning. It's Wealth Coffee Chat time, and that means it's Tax Tuesday. My name is Anthony Wolfenden. I'm a financial tax advisor with Positive Tax Solutions, and I'm here to give you yet another update on the, let's call it the Voldemort tax. This is Div 296, the new tax on superannuation. Might call it the Voldemort tax because it's the tax that cannot be named or cannot be named effectively. It's been changed. This is the third introduction to Parliament. It originally started back in 2023. The new bill is the Building a Stronger and Fairer Super System Bill 2026. And it's not, luckily, just a fresh coat of paint. To the government's credit, in the 2 and 3 years since this was originally introduced to Parliament, they've gone back, I guess, to the lab and addressed 3 of the biggest issues pointed out by the industry that have to do with this tax. So today we're going to have a look at the 3 and 10 rule, how that actually works and why this version of the bill is a massive improvement. Some of the things you should consider doing if you have a large super balance. For many Australians, this won't affect you, but there are a number of super accounts in Australia that are valued more than $3 million, and people who are near that threshold or over that threshold will need to take care. So let's have a look. Before we dive in, let's talk about the 3 fatal flaws that were in this bill back in 2023. The first issue was retrospectivity. Originally, this tax was effectively retroactive, which would be a little bit rude. So that's not great. In the 26 bill, there's a feature called a cost base reset. For the purpose of the tax, SMSFs can elect to reset the value of all assets held to a market value as of the 30th of June 2026. That's coming up soon, by the way, so we don't have a lot of time. This draws a line in the sand because the taxes that are triggered are capital gains and income taxes, realised. Another issue, we'll get to that in a minute. And so you want to make sure you've got the right cost base. We'll get to that in a little bit more detail. Issue number 2 with the original proposal was that it was potentially on the capital gains tax side, a tax on unrealised gains. You could have an asset held in the trust. It could go up in value. Your whole fund could go over $3 million in value, and you would be taxed on that increase in value even if the asset wasn't sold. This is blatantly unfair. Nothing else in the rest of the tax system in Australia really has a tax on unrealised gains. It was a nightmare to try and manage. There'd be all sorts of liquidity issues for farmers and people who all own large blocks or property, illiquid assets, and it just was going to be an absolute nightmare. So the Treasurer has basically backflipped on this, or pulled his head in, or got cowed. I don't know what you might say. The tax now on the capital gains tax side will only be on realised gains, dividends, rent, interest, and other things when you actually pocket the money. So that's pretty good. Another issue that came up that was really quite rude and a little bit hidden in the marketing was a lack of indexation. The DIV taxes, DIV 293, DIV 296, as originally proposed and as existing for 293, if you've been stung by that one, they weren't indexed. So the original proposal was to put a hard cap on a $3 million super balance. And as time went by, as total super balances were indexed, as contribution limits were indexed, that $3 million would stay a hard cap. And so over 20 to 30 years, inflation would basically drag virtually all Australians into a tax system that was sold to us as something for the ultra wealthy balances only. So they've added indexation in. There's a little bit of sting in the tail. They've kept the $3 million threshold. They've indexed that now to inflation, but they've also added in a $10 million threshold. But they'll be pushed up at a rate of inflation, and so that should move everything forward a little bit at least. So how does it actually look like today? Well, a tiered system introduced for superannuation is a little bit like the tiered system we have for income taxes for individuals in Australia. This will be a tax on realised gains, capital gains, and income, of course. And if you have a super balance, a total super balance worth more than $3 million, between 3 million and 10 million, based on the thresholds we've talked about, any earnings or gains above that threshold will be made proportional because they don't tax the value or the income below that to the same extent. But on the proportion above $3 million, there will be an extra 15% tax levied on the standard tax rate of 15%, taking you to a headline rate of 30%. Okay, so that's the large corporate rate of tax. So super for very large balances will look a little bit like a large corporate. It'll just have a lot more rules that you have to be careful of because the ATO is the regulator and there's all sorts of things you can and can't do. And just by way of a refresher, remember standard superannuation while you're accumulating is taxed at 15% for income. For most assets and capital gains, the rate's 10% because there's a bit of a discount. And then in pension phase for balances up to $2 million, there's no capital gains or income tax at all. When the balance exceeds $10 million and for the proportion of the earnings or gains above that, let's call that the high flyer tax, the ATO is going to levy an additional 20%, taking you to a headline total effective rate of 40%. So that's one of the highest taxes in the entire tax system in Australia. So basically the ATO is saying you really don't want to have super balances or income above $10 million. This is for retirement personally only, and we're going to encourage you to move balances or assets above that amount into some other structure or place and focus superannuation, I guess, back on what it was originally intended to be, which is for your personal retirement. Remember, it's proportional, so your whole balance or income don't get taxed on that amount, or your gains and your income don't get taxed on that amount. It's only on the proportion above those amounts. So why is this really important that you guys get? If you have a super balance near $3 million or soon to go over or anything else, can't stress enough, June 30, 2026 is now one of the most important dates on your calendar. It's not that far out. To use the cost base reset to make sure that when you pay capital gains, you're only paying capital gains from whatever you gain, not above 3 million or 10 million, but from whatever your super balance happens to be, the capital gain on the growth from June 30, you have to have accurate evidence-based market valuations on every asset in your SMSF that day. This is not something you want to guesstimate because the valuation is your shield. If you have $12 million in your super today, wouldn't you be lucky? That'd be great. But you don't want there to be any doubt about what the actual gain is from June 30 of this year until, well, the asset is potentially sold, so that you pay tax on the actual gain over the period of time and not some fuzzy number that the ATO can question. So the valuation is your shield, and this ensures that, you know, if you've had 20 or 30 years of growth or whatever it's going on, that portion stays in your pocket and it's not subject to these new 30 and 40% rates. There's a grace period for the first financial year, which is the 26-27 tax year. The tax is only going to look at your balance at June 30, 2027. So this basically gives you a 1-year window to restructure, move assets, remove assets, equalize balances, do all sorts of things that you might do to make this a little bit less impactful for you. And so that's a useful hint. So get everything valued in your SMSF or in your super before June 30. In regular super, it's done for you. In an SMSF, you have to take care of it. And then if you're near that balance or over it, you've got another year basically to make sure that you're not in there. If your balance doesn't exceed 3 mil, the calculations don't need to be done. There's nothing else that needs to go on. Of course, you might like to have a bit of a chat about it. So I'll put this up here if you're interested in finding out more. If you need some professional discussion from a tax perspective on this, you can give that QR code a bit of a snap. So that's basically it. It's much improved on where it was 2 years ago. It's going to Parliament now. It'll pass through the Senate and then get approved. I think this is the last major set of changes that we expect to see before the bill goes into effect and people with larger super balances are impacted. So wrapping up, number one, go see your accountant if you've got an SMSF. Number two, make sure you get them to do a valid and comprehensive valuation of everything you have in there. And then if that valuation indicates that your total super balance sits near or above $3 million, you may want to work with them to figure out what you can do to drop well below that. If you're already in pension phase, you can take things out into your own name, place them somewhere else. If you're still in accumulation phase, you're much more limited in terms of what you can do, but there are opportunities to do superannuation movements with a spouse. They're a little bit more limited in terms of what can be done, but it's worth consideration. Remember, in an SMSF, you each have a member balance, and the $3 million is per member and not per SMSF. Okay, that's it. Winding up Tax Tuesday. Thanks very much. All the best. And I guess we could all wish we had close to 3 million in super, because that would be a good problem.
Thanks for watching another episode of Wealth Coffee Chat, folks. Thanks for watching another episode of Wealth Coffee Chat, folks. Make sure you like, subscribe, and turn on your notifications so you never miss a thing when we go live. Improve your portfolio and investing game, folks, with Wealth Coffee Chats live every morning at 8:10 each weekday. Make sure you join us. Previous episodes are also available wherever you get your podcasts, folks, as well as our other podcasts from the 6-Star team here at positivementor.com.au.
To drop well below that. If you're already in pension phase, you can